2025 is the most crucial year for tax planning. Are you ready? Welcome back to our channel. I'm Karen Quintanilla, your proactive tax advisor, helping business owners and high income earners pay less in taxes legally and build long-term wealth. 2025 is the most crucial year for tax planning in decades. Why? That one big beautiful bill brings lots of changes that many people aren't ready for. And you have to get ready. You have to get ahead of the game. Smart planning now will save you thousands, even hundreds of thousands in tax savings. In this video, I will break down major changes, real examples, and advanced strategies to stay ahead of the IRS. If you like keeping more of your money, hit the like button, subscribe, and let's dive in. So today I have a guest here with me, one of my team members who will be asking and directing the questions that we have got from a lot of our clients and the audience that would like to know about these changes and what strategies should you be implementing, what decisions should you be making in the next few weeks and months. Today with me here in the channel is Brenda Collazo. Brenda, and welcome.
Thank you, Karen. Thank you. I'm super excited for this video that we're about to do because it's super informational and it's gonna really educate not only just the business owners, but also a lot of people that do their individual taxes. So right now, this big, beautiful act obviously has a lot of people concerned or worried. So my question to you, Karen, is like, how should the community react upon this big change?
So, as we stated, and we've been talking about a lot with our business owners, tax planning is going to be crucial. Mm-hmm. It's going to be extremely necessary that if you don't plan, you're planning to fail. If you don't have a plan in place, you're planning to pay high penalties. You're paying to pay a high bill. So either you plan or you pay the bill.
Get ready to pay.
Get ready to pay, right? Get ready to pay. So really exciting news, the standard deduction was increased. For single filers, was increased about $1,000. Mm-hmm. So it went from being $14,000 to now being $15,000 in standard deduction. So what that means is that if you're a single filer and you're making over $30,000, $15,000 of those $30,000 are being non-tax because they're standard deduction. You're not itemizing your deductions. For married couple, married filing joint returns, that was increased to $30,000. This year, which increased by $1,500. Previous year was $29,500. Right now, we're up $1,500. So you are at that $30,500 mark if you're married filing joint returns.
So Karen, I understand there was a lot of changes and we're going to hit certain topics right now just to kind of, inform all of our clients or those that are connecting with us at this moment of the difference of what was prior and to what is now. So the first one is the standard versus the itemized deductions.
So standard versus itemized deduction, a lot of the taxpayers used to itemize their deductions, such as, for those that have high medical bills, right? Medical expenses. If you pay professional fees, if you pay other type of expenses in your personal automobile depreciations, automobile expenses, you used to itemize your deductions. So if your deductions were higher than your standard deductions, then it makes sense. But a lot of people didn't have more itemized deductions than the standard deductions. So in 2024, we had standard deductions for single filers of $14,500. Right now, the standard deduction for single filers went up. So right now, we're looking in 2025 at $15,000. So what that means is that if a single filer is making about $30,000 a year, $15,000 of those $30,000 a year are non-taxable.
Okay.
So, the other $15,000, you're obviously paying income tax when you're filing your return. If you're married filing joint, then, your standard deduction went up to $30,500 for 2025, which is great. Now, Brenda, one thing that our audience and clients and everyone out there need to pay attention to nowadays is that the itemized deductions miscellaneous deductions are out of the window.
So can you give us an example of what was a miscellaneous deduction before that you can do that you can no longer do at this time?
Yeah, so many people pay for advisory services, personal training, professional fees, legal fees. Those were other miscellaneous deductions that will no longer be taken into account. Tax planning, in fact, is a business deduction. So that's a deduction that, yes, you need tax planning, right? You can still deduct, but your service fee basis, that was other miscellaneous deduction, all of that is out of the door. People used to pay uniforms. I remember that, we had a lot of people in the construction that they were buying boots, they were buying clothes for work-related purposes. That's out of the door. That's no longer a personal deduction. Now, this is why tax planning is so important. Because if you used to have all of these other miscellaneous, they used to reduce your tax expenses or qualifying income. What do I mean by that? So you may right now in a 1099 form, you work as an independent contractor, you have professional fees, you have legal fees, you have tax preparation fees, you have uniform clothes related to your job, you have other type of fees that you were paying. I can think of, utilities or other things that you were utilizing because you don't have a business and you were reporting all of this in your personal income tax. That is no longer an option.
So that's a huge change.
That is a huge change.
For a lot of people.
Yes.
And so there's no way that they're going to be able to deduct that at all whatsoever.
No, that's why you need tax planning, because if you're an independent contractor and if you have an LLC, if you have a pass-through entity, then those deductions can be, if they're according to business and they're related to your day-to-day operations of your business, then those can be business expenses. But if you're reporting on your personal, that's no longer an option.
So it'd be super important for those people that normally just report it on their personal to either open up an LLC so that they can go ahead and add those deductions.
Correct. If they're business-related expenses, if you buy clothes for your job, right? So then now it's through your LLC. If you're utilizing space in your house for work-related purposes, or you have a home office deduction, then now those become business-related expenses, not personal expenses. Okay. But before you were reporting that in your personal tax return, that's no longer an option.
Wow, that should open the eyes of a lot of people, because that's how most of the returns are done for a lot of the community.
Correct.
So you need tax advisory service. So you need to visit us at King of Kings so we can help you with that if you have not thought of ever opening a business, so that now you can start making those deductions. Now, Karen, all these changes, obviously they're going to be here during the term, correct? During the term that we have till 2028, correct?
That's correct. So some of these changes are going to phase out. There will be changes December 31st, 2028. Okay. So this new act, some of the changes are permanent, and that's a great news, and we'll talk about that. But some of these changes are going to phase out December 31st, 2028. So, but as for the next 4 years, you have to adapt yourself. You have to reinvent yourself. You have to plan. If you don't plan, you're planning to pay high penalties. Some of the good news that we have is the SALT tax.
Correct. I know that maybe this particular topic, a lot of people may not understand it. So can you kind of explain to us what that SALT deduction is?
So the SALT tax deduction is your local, state, county tax. So we have property taxes for those of you that have, properties that are worth more than $750,000, $1 million or higher. You have your property tax bill, which is shows in your escrow mortgage statement, and that's a very high amount. Some of you are paying in taxes more than $15,000 to $20,000 on just your property taxes. That's not including your vehicle registration estate tax. That's not including school tax, local tax, and obviously, Brenda, that's not including your income state tax. Now, what is the important part about this? Mm-hmm. That the SALT tax went from being $10,000 to $40,000. So $40,000 was increased by $30,000, which is amazing. It's going to help many high earning individuals out there, and many people that has properties that are obviously, like I stated, worth more than $500,000 property, where your property tax it goes above $10,000 a year, or you have multiple properties where you're paying already this county, state, and local tax, and then not including, like I stated, your income tax. Now, where is the strategy here, Brenda?
Well, that's a good question.
That's a good question. How can you make these taxes pass through to your entities and be a deduction of your entities and not a taxable income to your personal? Here's where you have to strategize. What taxes are you paying? You have to become knowledgeable of, how many vehicles do you have, and you're paying registration tax for that. How many properties and how much are you paying for your property tax, and what is your income tax liability? In the state of Georgia, we are in a taxable state, so we know that we are to pay income tax in Georgia. And so therefore, what is that state liability tax that you have, that it can be a pass through to your entities and be a deduction on an entity of your own?
I know one of the things that I had heard is that certain things federally you may not have to pay taxes on it, but we're still waiting for the state to make a decision if taxes have to be paid on it. So it's super important to stay informed, especially through this channel, with all the updates that Ms. Quintanilla is going to be giving, because it is super information that you're going to need. It's going to help you out, especially we're already in the month of July. We're halfway there. Tax season is within 6 months, 7 months. So it's crucial for you to understand these changes on how you can benefit from it and what you need to do to prepare.
Correct. So, you mentioned that some states will have a definite answer on which taxes will be paid or not, and that goes back to your many people are misunderstanding your tips tax. There's no taxes and tips, but when they say there's no taxes and tips, they're not saying there's not self-employment tax, meaning that you will still have to report your tips in a W-2 form.
Okay.
You still have to pay self-employment in a state tax unless you are in a state that is not taxable. However, if you are in one of the 43 states, you will have to pay state tax for the tips. Now, what is a no tax on tips? It's no federal income tax on tips.
Okay.
So you have to read the code and the act correctly to understand that that tax that you're not being taxed is federally, and it does phase out. Single filer $75,000, married filing joint $150,000. So it's not you're making $300,000, you're making $500,000, and you're claiming no federal income tax on tips, right? So I get my bonuses on tips now, and I get to not get federally taxed on that. That's not the case. So it's case by case basis. When it comes to overtime, overtime is huge. We as employers like to pay overtime to our employees. Our employees don't want to work overtime because they get taxed. So now this is a huge benefit, but mind you again, no tax on overtime means that you're not gonna pay federal tax. However, you're still paying self-employment tax and state tax if you're in a state that is taxable.
Wow. I think a lot of the service industries may think, it's gonna affect them in a way, and they'll probably, try to see what can be done. Unfortunately, if you're in the service industry, these are the changes that are occurring now. So it's super important to stay informed, or even talk to their employer, to see what can be done to help them out. Because I know, just like you mentioned, overtime. Some people like overtime. They like the extra hours, but they don't like to be taxed on it.
Exactly, because you're working 10 to 20 hours a week or on a bi-weekly basis, and you're getting all excited that, yeah, it's a bit extra money, but when you look at your paycheck, it's like, oh, the deductions are gonna continue to be. You're not going to be taxed federally in your income tax, but you will still have your self-employment tax. So you're still gonna be reported on a W-2. You will still be withheld from your overtime, and the only tax that it is not going to be, or you're not going to see, again, it has phase outs depending and according to how much you make. If you're a high W-2 earner that you're making $300,000, $250,000, or even more, then we'll have to look at different type of strategies for you. But if you're, a single filer, 75,000, married filing joint 150, then we're looking, at a cap there, right, when it comes to your overtime, how much overtime you're reporting.
So get ready, guys, because a lot of changes are coming. And I know some people are probably feeling a little bit nervous about the change, because if they don't have, or they don't see these type of recordings, they're not being informed, they're gonna be like, I probably just won't even do my taxes.
Yeah, that's not the solution, right? So one of the other good news here for those that want to continue to grow wealth, want to plan proactively, and want to have tax savings towards the future. Number one, you do not wait during tax season. That's being reactive, and you're going to be late. All of these changes are happening now, so you have to make decisions now in 2025 so that you can execute them and implement them in your returns in 2026. So therefore, the time is now. But bonus depreciation is back. So for all of those business owners that, decide to buy equipment, going to buy properties to offset tax liability, machineries, assets related to your business or non-business related, bonus depreciation is back 100%. The asset have to be purchased January 19, 2025 or forward.
Okay. So that's good.
That's extremely good because let me put an example, right? So you today are married filing joint, filing a return, and you have, let's assume, $250,000 in income in your family. And so now you're being subjected to pay, a tax. We're just gonna make an assumption that your tax liability is $30,000. With those $30,000, you go and buy either an asset related to your business, equipment that you need, or let's assume you buy a rental property. So now we get 100% of that bonus depreciation of that rental property, and we can utilize in 2025. That asset have to be purchased January 19, 2025, or futuristic forward.
One of the other things is AMT. What happens there? Or what is AMT? Let's explain to everyone.
So AMT is the alternative minimum tax. That has come back. So that's more for like high tax individuals. That's for, stock options. That's more for like big capital gains. So if you have investments, S&P 500, if you are cashing out on Bitcoins or other type of investments that you might have, then this is an option for you. And then again, these are things that we do have to look at closely at one-on-one basis, but do know that it is back. You do have options, and there are a lot of things that you can do to save in taxes.
So please, if you have not yet seeked a tax strategist, we are here to help you because it's super important with all these changes. I know before, we've seen it here, we have people that come in and they're like, sit down with you and you present to them certain things that they can do, how they can save, and they're like, oh, okay, I'm gonna wait. They're late. They're super late, because I don't think a lot of people thought this was gonna go through.
Yeah. I mean, one of the things that tax planning, again, it's a whole year planning, right? So this planning is for your life. You gotta understand that it's a mindset. You gotta change the way that you see life, right? Life with a purpose. I always call it life with a purpose. It's how do you invest in yourself, and how do you invest in your future? How do you invest in you so that you can obviously save in taxes and maximize what you have and maximize your assets? You have to be proactive on this. You can't be reactive. You can't come about and be like, I was too busy throughout the year. There's no excuses. This is a tax bill and you gotta pay for. Now, if you plan to reduce and to invest, you will take benefits. So if you're a parent and have children, right? Let's talk a little bit about the 529s. I mean, 529s are back and they're permanently. So in the event that, God forbid, one of your child becomes disabled or something like that, you can take money out, zero penalties. You can take money out to cover for those medical or disability expenses that you might have. 0% penalties when it comes to withdrawing from your 529s. Now, what is the other benefits that you have? Right, so if you're paying private tuition from kindergarten to high school education, you can pay. You can invest in a 529 plan for your children's for their education, and you can withdraw, to pay for the tuition. If you have, student loan interest or other type of student loans that you gotta pay, and you did invest it in a 529 plan, then you can, make such deductions for education-related activities. In the event that your child didn't go to school, yeah, you can, withdraw the money as a parent, as a guardian. That's a different story, but we want our children obviously to go to school and to, have that college degree, but we want to make sure that we plan for the future. You can also do rollovers from your Roth IRA into your 529 plans.
So if the 529 is not used for education, they can still withdraw it with no issues?
That's the guardian only.
Okay.
Yes, that is not the child.
Okay.
Yeah.
So only the parents can.
Yeah, in a certain age and certain time limits. Yes.
And this is from here on. That's not something that you think they'll take away?
At the moment, it came to stay. Obviously, again, we cannot anticipate what's gonna be changed or not, right? Congress makes such changes, but December 31st, 2028, we should be expecting more changes in the near future.
Wow. It has me with, like they say, con la boca abierta, with your mouth open, because the 529 is something super important that before they could not retrieve the funds if they didn't use it for education, and now they can.
Yeah.
Then they can use it for whatever.
Yeah. Not for whatever, right? But it's for education-related purposes.
Okay.
And yes, it has to be for education-related purposes. And in the event that the child or the beneficiary becomes disabled, then you can pull and withdraw the funds from the 529 plan. So this is another benefit that you have for you, and to add on to that, you can do transfers or rollovers from your Roth IRA into your 529 plans, which this is another benefit that if you have a management company, family LLC, and your children are in payroll, then you can contribute up to $7,000 into the Roth IRA, and from there roll over to the 529 plans.
Wow. So take advantage of it. It's not even an advantage, just know what's available to you, because we have, it, God forbid, it does happen. Maybe your child does not go to school, to college, but something medical does happen, and they don't know that they can use this money for that, for a disabled child, just like you happen, God forbid that something happens to any of our children, but you have, I will call it like pocket money, just to know you can rely on that, especially if it comes from one day to another, which in some circumstances we've seen this issue does occur within some families.
Yeah, no, and a lot of the benefits that you have to you available is that health saving account, the HSA account. So now if you contribute into an HSA plan, you can not only pay for medical related expenses, but you can also have for your gym membership. This was not there before, and now this was a huge benefit that was added. I think this administration, this government wants us to stay healthy.
I was about to say that. You see everybody start rolling into the gym. It's like, let me use my HSA account for this.
Yeah, so most definitely you can use your HSA account for that. You can, pay for physical therapy and any other related, fitness matters, or to be better, right, for health related activities. So do contribute to an HSA plan. This is huge savings. I was just speaking with someone earlier today. You go to the pharmacy all the time, you buy prescriptions or non-prescribed medications, and you're paying out of pocket. So when you do the math, sometimes you end up spending more than $3,000 a year. Why not contribute into an HSA plan tax-free, and you get to save this towards the future in the event that you don't use it in the calendar year. So this is a huge benefit that if you're out there paying for your gym membership out of your debit card or your credit card account, use an HSA tax-free account, health saving account, so that you can pay for your gym membership.
So that's good news. They really want us to get healthy. But I mean, it's good because we have to put into our bodies. We have to, take care of our bodies. So hopefully that'll help out a lot of the community to stay healthy and, be able to save on those particular extra little taxes that they pay when they're trying to pay for a gym membership or for the other, medical stuff, like you said, Band-Aids, alcohol, little things that you don't think you can put on the HSA account, you can now.
Yeah. And so if you want more of these tips, don't forget to subscribe, follow us on YouTube and our social media. Here at King of Kings Business and Tax Advisory, we help clients protect their wealth and legally write off their tax liability. So stay tuned and be on the lookout for more of this content.
Thank you so much for tuning in. See you soon.